It's hard to breathe, but that's alright. Hush.
Hey, what's going on, guys? So I want to talk about hedging. So I'm going to explain what it is quickly, but before I jump into it, I just want to say hedging is like a very key concept in trading that can really help to secure your profits or limit your losses. And it's important that you hedge correctly. Otherwise you can end up needlessly losing more money than anticipated. But I'm going to try and explain anyways everything that you need to know about it, including what hedging is and how to trade or hedge your trades effectively, I suppose. Right. So first, what is hedging? So hedging and trading is where you open a position that goes against the current open position. So if you have an open long position on Apple and then wish to short Apple, as you believe its price will fall, you can then hedge Apple by opening a new short position. Both positions will then be opened simultaneously. Many brokers and those offering trades and positions will hedge themselves as a way to manage their own risk and ensure losses are covered. For example, if a broker accepts a short trade of £5 point on Apple, if Apple prices fell 5,000 points, something that's unlikely but certainly could happen, the broker will lose £25,000, not including the spread either. That's not too damaging, but if multiple traders open similar positions, the exposure will be large enough to severely impact the broker. Therefore, the broker will have to place a short trade on themselves on Apple. Right, so that if its price does fall, the broker won't lose out and can cover the costs. Right. So why should you hedge a position? There are two main reasons why, as a trader, you should hedge a position, and they are protecting your profit and short-term gains. So protecting your profit, say for example, if your position is profitable, to protect the positive P&L, you can open a hedge and effectively add a second position in the opposite direction. This means that should the market turn against you in the initial trade and make it non-profitable, profit will be earned from the hedge trade and loss will be incurred from the initial trade, but less will be lost than if the hedge was not placed. Short-term gains, in the short term, the price market might be moving against your trade. Say you opened a long trade on Apple, but its price is falling drastically following a weak earnings report. You might believe that Apple will recover and be profitable in the future. So you want to leave your initial trade open, but at the same time you want to take advantage of the price fall in the short term. Hedging enables you to pretty much keep your long-term trade open while opening a new position that looks to take a profit in the short term. Now, the way I do it is if I'm looking for a swing entry, so for example, I'm looking to hold into a trade for the next couple of days, even to the rest of the week. So for example, if I open it on Tuesday, I want to get out Friday, that's classed as a swing trade. So what I'll do is, if I'm in a long position on GJ and I'm holding that till let's say a few days, in that next day I might open a short position on GJ. Right, but I won't have my take profit set, past my stop loss on my long position. I'll have it, short term. So if you correlate this with market structure, it's exactly the same. Because if we just zoom out here to the 4-hour time frame, right, and just remove everything here, right, I'll just delete everything anyways. But as we can see, right, what is price doing? It's moving to the downside. We have a high, we have a low, we've got a structure broken, low, high, low, high. So as you can see, at this point we are bearish, right? And we're still within this range, so we can look for sells effectively in this range. Okay, as you can see, there's a supply zone here. So what we could have done, which we did, some of us anyways, because I sent it out in the analysis, but yeah, as you can see, we're looking to sell from the supply zone. But what we could do, when price is here, if we just ignore what's going on over here, when price is here, you could actually look to buy leading up to that sell zone. Now, in terms of where you'll take your profit, here's the catch, right? You would not want to set your take profit on here. The reason for that, well, you can do, but remember, you have to manage your position as we know how to manage it. So you can manage it for as long as you can, then that's awesome. Because, for example, if you open a long position, or if you open in a sell position and you open long positions, buying into that sell, you're approaching, this zone, anticipating that you're looking for the market to reverse. But if we look at the structure, right, we know that the overall market structure is moving to the downside. So right now the order flow is bearish. Okay, so why would we want to buy if the order flow is bearish? And order flow, again, is just institutional order flow. It's like, for example, if they're in bullish structure, why would they want to sell? They will eventually, but if they're in true bullish structure, why would they want to sell? And the banks do this as well. They hedge their positions because they have to, because obviously the people have a lot of control over the market compared to us. They have to make their swing points because it's all liquidity. As we've spoken about market structure, these imbalances and price will happen, and it needs to retrace in order to fill those imbalances, right, before moving the initial bearish move. Now, as you can see, again, we could just simply look to buy leading up to that sell zone. Now, in terms of take profit, We don't want to sell or take profit here. We just want to manage it effectively as we know how to manage it. But the reason for that being is because simply the order flow is bearish. So we know that the market can reverse at any time. So if we buy from here, we have to anticipate that the market could reverse anywhere along here, right? Even here, it can reverse at any point, and we must understand that. So don't have unrealistic expectations, right? So set your take profit in areas of, liquidity on the smaller time frames, and I'll talk about the time frames in a minute and what time frames you should use to hedge. But yeah, that's pretty much it. Now, why should we hedge is, again, like I said, it's protecting your profit or even the short-term gains. And if you're in a long position over here and you're looking to sell, you can buy and sell and buy and sell, because as we know, the market has to move up and down. So why not catch those buys and then catch those sells, to buy, to sell, to buy, to sell? Why not be like that? And that's simply what we do when it comes to hedging. So again, even though we're looking to sell from this supply zone, so if we had a limit order sat there, for example, right, and our take profit was all the way down here, and anticipating that price is going to make lower prices, we can just effectively buy into that. But just never set your take profit on to the supply zone, because if you set your take profit in a specific area, it even applies for just general rule of thumb. When you own a trade, don't set a take profit anywhere, right? Just manage the trade and see what that trade turns into, because if you set your take profit down here, then you're going to take your profit down here. But what happens is, if you manage your trade, what happened if you just managed your trade and it never actually closed above, right? As we've spoken about, as you learn, right? What happened if it never goes above? Then that trade could continue to go on and go on and go on. Yeah, it will eventually, break above, but it could come down to here. It could get a massive, drop down here before breaking up. And that initial trade from being, let's have a look. From being here from a 4.63%, it could turn into a, 11% trade nearly. Right, and that's just from a risk entry. Obviously, on a small time frame, you could jump into that and get a better risk reward. But you get the idea, right? So that's pretty much hedging. And if we look at an example, I did have an example. I'm sure it's on your dollar right now. I'm lying. I don't know where I had an example somewhere. Was it in pound dollar? No, it wasn't anywhere. I think I'm lying to you guys. I think I deleted it already. But I do have an example. It's on the if you go into the section with all the PDFs and the PNGs and the files, you'll see in there that I've put like an example up for you, and I'll draw one now quickly as well. So price is doing its own thing, right? We're looking to buy from here, let's say, right? And as we know, the market moves up and down, so this is why we do hedge. And say, for example, we're looking to target down here long term, but we're just going to obviously, of course, manage it. We know that the market's going to make higher highs and high lows. So, for example, if price does this, and we look to add to our buy position here, and then we see a supply zone which we could get a short-lived reaction from before moving up, why not catch that sell position here and look to target a demand zone down here? Because these price moves aren't random; they will always tap into some sort of supply and demand zone. And whether it's a break or whether it's an imbalance, it's all supply and demand. That's how the market moves. So there's a reason for why price is reversing at certain areas. So if there's a supply zone sat there, why not take a trade and target the first demand zone that you see, right? Because it will start to do that. And even within these moves here, you will catch trades, right? Now in terms of time frames, here's the thing. So if you have a H4 point of interest, right, and you are looking to swing trade, so what I mean by that is, if you're looking to, you focus on the long term, if you're not managing your position, you just focus on the long term anyways. This has so far been open for 5 days. So that is classed as a swing trade at this point. So within this swing trade, why not take those lower time frame buys? Even though price is being down, take those buys, okay? And in terms of time frames, sorry, I keep going off track, I do apologise. But if you're using the H4 and you're looking for swing trades between the H4, daily, whatever, go down to the 5 minute and below, right? Or 5 minute, 15 minute, 30 minute, and that will be your sort of intraday trades. So what you can do if you're holding a swing position open on oil or West Texas oil that we're on, and you're selling, you could effectively buy in that certain day. So for example, on this day when it reversed, on the 13th of August, right? If you wanted to, you could buy on the 13th of August, right? There's an example. But you could buy, and that would be your intraday trade, because an intraday trade is where you open position and close a position on the same day. So you could buy, even though you're in overall sells within the swing trade, okay? And then if you're intraday trading, right? If you're buying here, for example, what we can then do is go down to the 5 minute and the 1 minute time frame and then look for those scalps. Okay, so for example, if you have a hourly point of interest, a 15-30 minute point of interest, whatever it is, right? What you can do, say for example, if we're anticipating for price to push up to here, what we're doing is we're looking to sell. So what you can do from there is, right, you can actually look to buy from here. So for example, you want to buy from here, right? We want to buy from here. You know, we're going to do that. And that'll be your scalping, because we're going to hold these trades for a few minutes, because obviously, you know, we're on a 5 minute time frame. So if you got, you know, if you have a 5 minute point of interest here, go to the 1 minute time frame, you know, look for those buys leading up into that 5 minute supply zone. So for example, I want to buy from here because it's tapping into a demand zone, have my stops below there and take profit above there, and that would be a nice little trade, right, of a 3.42%. and as you can see, it's already in profit, right? So we could just manage it now and have your high here, have your low here, and if price, you know, leaves as high, just keep managing the trade to where the high is and the low is, and just keep managing the trade. All right, and what eventually will happen is sometimes is, even though price is going to, you know, potentially sell off somewhere, we have a supply zone here. We could be wrong, so we could hold on to that hedge long position, and when price starts to see the break of structures to the downside, that's when we could, you know, obviously close out our long positions as we break below the lows, but also we can look to sell from here then as price, you know, retraces back into an order block. We can then sell, right? So that's just how you do it. Okay, so I'm gonna end the video here, but that's pretty much hedging explained. It's like if you're, you know, it's a buy to sell approach or sell to buy approach, whatever you want to call it. It's all hedging, and a lot of people do it because, again, it's short-term gains and you're protecting your profit. So, you know, for me, when I come onto the charts on the beginning of the week and the end of the week, I look to obviously look for swing trade opportunities, and then I look for intraday opportunities, and then I look for scalp opportunities. So if we go back to the H4 on here, if I'm opening a trade here, I'm expecting to hold it for the next few days, right? What I'll then do is I'll keep my position open, remove all that out of the way, and then I'll go down to the 5 minute, the 1 minute, and look for those sell opportunities, you know, and buy opportunities as we are still in the swing trade. Because as we know, the market moves up and down, so why not capture those short-term gains, I guess, right? But yeah, it's completely up to you. So I just quickly wanted to add on to the end of this video the advantages of hedging, and I also wanted to add in the disadvantages as well, so the pros and cons. So the advantages, so the pros is that it protects your losses. So should the market turn against the position that you have hedged, the hedge position will cover some of the losses and ensure that you don't lose 100% of equity of the initial trade. So an example of this is if you open a long position and then you open a short position on, you know, pound yen, whilst you're in that long trade, if the market reverses and then comes back to, you know, takes you out of break even, or even takes out your stop loss, you're still in that short position. So that's the advantage of that. And also it relieves your stress and pressure. Now you're probably wondering, how is it going to do that? And the truth is, with a proportion of the exposure from the initial trade hedged, less will be lost. So there's less worry about the market going against you. Okay. But obviously you've got to be smart about it. It has to obviously be implemented and, you know, applied into the, you know, testing. You have to test it, obviously. Also it secures profit. So profit that is already earned with the market rising can be secured by hedging the position. It allows greater exposure. If the risk is mitigated through hedging, it can allow you to increase the exposure for a trade safe in the knowledge that if the markets don't act in your favour, not all of your funds will be lost. It also allows you to withstand volatility. So periods of volatility and extreme fluctuation that might normally force you out of the markets can be countered with hedge trades that can help to secure a position and combat the volatility. It also saves time when you might have to regularly track an open position in case its price is changing. Hedging means that even if it did, you wouldn't necessarily need to close open or make any changes to the trade. Okay, short and long-term gains simultaneously. So if you have a long-term position open on a market, but you want to take advantage of your short-term price movement that is acting against that long trade, long-term trade, then hedging allows the two contradictory trades to be open at once. Right, you can consequently take advantage of a price movement in either direction of the market with two open trades simultaneously. Right, so the cons about it. So the disadvantages is eat into profits. So if a market moves in favor of an open position that is hedged, the hedge trade only cuts into profits and is mitigating risk that hasn't come to fruition. Right. Lose more from spread, as hedging requires a second position to be opened. A spread is taken from both trades. This means that if the market does not move, the hedge trade is not needed and more spread is lost. 3. Not beneficial to short-term strategies. With markets moving heavily from day to day, hedging can be a difficult strategy to master for day traders. So for example, if you're not looking for swing trades, you're not looking for intraday trades, you only scalp, then it's going to be much difficult for you to do that, right? And yeah, that's pretty much it really. And that's just the pros and cons, and yeah, I'll see you in the next video.